Good morning, everybody. Appreciate you, taking the time to participate in and join the PENTalk. I'm Mike Randazzo. I'm Vice President of Investments here at Pentegra. And in the next 30 or so minutes, I'm going to walk you through our fund selection and monitoring process. Now, a couple housekeeping items before we get started. All of you should be muted. Just do me a favor to be safe. Please hit the mute button on your phone so we can minimize potential background noise that can arise from time to time. So, in addition, if you have questions, please type it into the question area that you should see on your screen. So, with that said, a quick bio on who I am. I've been in the, again, I'm Mike Randazzo. I've been in the industry, as an institutional investment consultant or manager for nearly 28 years. In fact, I've been in my seat here at Pentegra for nearly half that time. So, as chief investment strategist here with Pentegra Trust Company, I'm responsible for, among other things, investment policy development and adherence, fund monitoring, selection and replacement, performance attribution and analysis, and client servicing. I'm not doing this alone here at Pentegra. I think for those of you that are familiar with the organization, we have a pretty deep staff here on the investment side. I'm one of 10 professionals, all of which are seasoned, in the least amount of time in the industry is 12 years. Most of us have double that. So just turning to the agenda slide here, today's discussion is going to include an overview of our investments philosophy specific to DC plans. Okay, then we'll go into key features of our process as well as the components of a comprehensive investment policy statement. We'll also discuss Pentegra's favored, as we call it, keep it simple approach to menu construction. And finally, we'll dive into the investment process, which is critical from a fiduciary standpoint. Okay, philosophically speaking, and I'm going to read this verbatim directly from the page, but this is critical and it really sets up the balance of the presentation. But, we advocate best-in-class investment menus that include a broadly diversified combination of major asset classes and limited number of funds that are suitable for participant-directed DC plans. Okay, the menus we design are there to maximize the typical participant's ability to build a diversified and risk-controlled portfolio of funds that will help to fund their retirement. Okay, this is a statement we've stood by for a long time. I've been here, nearly 14 years, and we've been applying this and using this for at least that long here. Okay, as this slide here indicates, okay, there's 4 key features of our process. These include, as I said a little earlier, but following a keep it simple approach, which I'll get into in a minute. We'll dive into that. It's objectively constructing a broadly diversified menu of funds with distinct asset categories. Importantly, to helping sponsors and advisors to fulfill their fiduciary responsibility by collaboratively developing and following an investment policy statement. Okay, and finally, it's delivering a comprehensive due diligence investment report, that provides the status of each fund offered on the menu. From an IPS perspective, okay, this is, writing the IPS or the investment policy statement is one of the critical first steps in our process. And, as we onboard clients, okay, the IPS provides, as I always say, the roadmap for managing the investment side of the DC plan equation. Okay, in fact, we won't be discretionary trustee for a plan without an executed IPS. Executed meaning one reviewed and signed by you as the sponsor, and also by us as Pentegra Trust Company. Okay, what goes into the IPS? I'm guessing a lot of you know this already, but just to review this. Okay, the IPS documents the background and purpose of the plan, the objectives and goals for the plan, responsibilities of all parties involved, okay, the specific asset classes and funds offered to participants, and the performance evaluation standards for the funds, including peer groups and market benchmarks, and of course investment review, and monitoring procedures for the funds. All right, all that is what's the word, documented in the IPS, a critical component of onboarding a client in the ongoing relationship. Okay, it's reviewed on a regular basis, annual or every 2 years, to make sure it's consistent with the goals and objectives for the plan. Okay, on the next page, I've spoken about keep it simple, or at least I mentioned it. What do we mean by keep it simple approach? Okay, here's what we mean. We mean that if we have, if you give us a blank sheet of paper and we're asked to construct an investment menu, then we would submit what we call a streamlined menu that includes, as it's up here and just below the heading of the page, but it includes, a limited number of asset classes and funds. And, just focusing the attention in the middle of the page with the boxes, I'm going to summarize this, but, specifically the menu would include one fund from each of the core asset classes and what we call a professionally managed option. Most of the time it's a target retirement fund series. Okay, so, we've spoken with a number of you about this, and you've heard us say it, but there is, that's not all we offer. There's flexibility in the approach, because some sponsors and advisors want to include, additional asset classes and potentially even multiple funds within an asset class. That's okay with us. We do have certain parameters, but we allow it. So, but if we're giving us a blank sheet of paper, we're keeping the menu very streamlined, keeping it simple, as we say. It would have 8 standalone funds. Okay, one each in large cap U.S. Large cap blend, growth and value. One in small cap and mid cap. One each in small cap and mid cap. One in non-U.S. equity. One intermediate term bond, and one stable value, as well as, what I said this earlier, is the professionally managed option. Typically, it's the target date solution. So, we do offer what we call supplemental asset classes for inclusion on the menu. Just by way of example, some of them, emerging markets, global bond, high yield, and there's other sector funds, REITs, etc. Those are, in our opinion, are supplemental asset classes. Quite frankly, we don't believe they're necessary to have as standalone options. There's ways to garner exposure to those asset classes. One could be opening a mutual fund window for participants, but the other one is that the core options that we use in the program, and I'll give two examples, one being non-U.S. equities. Okay, the non-U.S. equity funds that we have on our select list allow for the investment in emerging markets. Okay, not only developed, but emerging. And it's in a relatively sizable allocation, somewhere between 20 and 35%. So we call that opportunistically investing, but the professionals are the ones that determine how much goes into emerging markets versus developed. On the other side, you have fixed income or intermediate term bond. The funds we have on our menu will opportunistically invest in high yield, as well as non-U.S. bonds. So again, we like to leave that decision up to the professionals. As your typical DC plan participant, I'm not saying everyone, but your typical DC plan participant, is not really, doesn't have the tools, doesn't understand those asset classes as well, and how to appropriately incorporate them into their, their broadly diversified portfolio of funds. So, our selection, our process, selection monitoring and process, replacement process is based on, we have 7 tenets on the page. None are more equally, more important than the other, but these are the tenets. The first is suitability. Okay, our due diligence, in our opinion, ensures us that each fund on our select list and in your plan or used for your plan is suitable for a participant-directed DC plan. And I like to give examples for, and the example here is, you won't see a fund on our menu or on our select list, I should say, with 20 stocks. Okay, from our perspective, it's way too concentrated, can be too volatile for a DC plan, participant-directed DC plan. Another example could be the large growth fund. Okay, it won't have 65 or 70% in tech. All right, so that's, again, it's way too concentrated for something, for a DC plan, participant-directed DC plan, in our opinion. Objectivity points to the fact that we don't care what fund's up on our select list. Okay, we're not offering proprietary funds. We're not getting paid by the fund families. We don't seek to get paid. Okay, we simply want the funds that best represent the various asset classes. Okay? And we're avoiding, at all costs, we're avoiding any perceived conflict of interest. Okay, as for due diligence, that's the backbone of our process. Okay, we run each fund through our screening process prior to placing it on the select list, as you'd expect. And then once the fund is on the select list, we run it through our screens on a quarterly basis to make sure it's meeting expectations and aligned with investment policy. Okay, look, I'll be the first to tell you, right or wrong, we don't get everything right all the time. Okay, so invariably, as we go through our due diligence, and at some point, a fund is placed on the watch list. Okay, and periodically, we even need to replace a fund. So, that's not often. It's atypical, but it does happen from time to time. And quite honestly, our turnover of funds is very industry standard. Maybe one a year, maybe one every 2 years. So 5-10% turnover on funds. But I will say this: make no mistake, you as the sponsor advisor will be well informed. And they won't be surprised by changes if and when they happen. So, from the long-term our long-term orientation, we believe it aligns our process with the type of money under our purview. These are retirement plan assets that should have a view for the long term, and our process does this too. Our process does too. Okay, and specific to this end, if I've met with some of you in the past, but this is consistent with what I've been saying since I walked through the doors here. We may not replace a fund just because it stumbles in 1 year or even for 2 years. Okay, there's more to fund selection and owning a fund, so to speak, than just performance. Okay, in our opinion, it's a mosaic of a number of factors, and if most of the original thesis still exists for having put a fund on the buy list, then we'll definitely give managers time to work through a soft spot in their record. Particularly if the long-term record was created or built by the same people that are managing the portfolio currently. Okay? We've seen countless times in the decades, certainly in my 3 decades in the business, countless times that strategies can be out of favor for a period of time, especially if it's explainable, if it's a deep value manager, and the market, like currently, is not favoring those types of strategies in their universe. All right, but if they're consistently applying their process, same people, same process, then again, we will give them time to work through it, because we've seen so countless times that a manager lags for a year and a half, then all of a sudden the strategy comes back into favor, and they more than erase the performance deficit when the market reverts. So again, that doesn't mean we don't make changes, but we have a long-term orientation. Now, diversification points to a couple of items. As I alluded to when I explained suitability a few minutes ago, all funds on the select list are diversified by number of holdings and sectors. Again, exceptions are some of the supplementals where it's a sector fund by definition isn't diversified by sector, but those are special circumstances. Okay. In addition, as I already discussed as well, the menus themselves are broadly diversified by asset class. Okay, critical in the construction of menus is diversification. Style consistency is straightforward. Okay, we're looking for truth in advertising. If a fund has small cap in its name or professes to be small cap, well, it better be small cap all the time. We don't want it marching up into the mid cap space. Okay, we want it to be small cap. If it's small cap U.S., it better invest in U.S. companies. Another easy one, if it's a value fund, then it better be a value fund all the time. So those are the types of things we look at. And finally, and this is, I'm sure, critical to everybody on the call, is expenses. Okay, we are looking for the cheapest to deliver share class for a fund, that has no revenue sharing if we can find it. Okay, ideally, we want the cleanest share class as possible. Again, moving away from that perceived conflict of interest, as well as keeping costs as low as possible. We don't want that headwind, neither do you. So if you haven't seen our funds already or seen the expense ratios relative to their peers, because that's an important page that goes into the quarterly report and something we spend a lot of time on, you'll see that all of the funds on our select list, whether they're sector funds, whether they're core options, target dates, etc., they're comfortably in the in the cheapest half of the peer group. And actually most of them, I don't know the percentage, but I bet it's 80 to 90% of them, specifically, are in the cheapest 25% of the peer group. What I always say here is just it's important to know that we're not looking for cheap just for the sake of being cheap. We won't jeopardize the integrity of our process just because a fund is cheap. Just cheapness doesn't equal good. Okay, there's so many other pieces that go into the figuring out that puzzle. Okay. So here's our investment process page, and this is just a simple schematic of our process and the steps that are involved. It's a 5-step process, okay, that equally blends quantitative with the qualitative, and the primary goal, as you probably expect, is finding appropriate funds for the various asset classes. Okay. The process itself, again, something I've been saying for almost 14 years here, and even longer in my past life, is we use a beyond the numbers approach. Okay, we do spend as much time on the quantitative as we do the qualitative. Okay, understanding performance is the proof statement, because you could have a very sound and great sounding process, but it doesn't translate into performance. Okay, but performance being the proof statement, we believe there's a number of factors that lead to a fund being, I'm going to put this in quotes, a fund being strong, a fund having a good long-term record. So the next couple of slides, I'm not going to go to them because I'm going to continue on this page, but just go into the, gives you a high level, some ideas on what we look for quantitative and qualitatively. But I'm going to say it here. So, quantitatively speaking, we cut the numbers so many different ways, and most firms do cut the numbers similarly. But, we're looking at short, intermediate, and long-term performance. Okay, we're looking at as I call it, period-specific performance. Such as how a team did leading into the credit crunch, how to do during the credit crunch, how long did it take to come out of the credit crunch, and how did it do? So that's something that we look at. Various risk-adjusted return metrics, style consistency measures, and of course, as I mentioned earlier, fees. Critical. From a qualitative perspective, investment. We'll look at an investment manager's organizational structure. Okay? The tenure, depth, and continuity of the portfolio management team. If you're familiar with our process and how we do things, but we favor team approaches over star systems, and really that's because there can be a significant amount of turnover in this industry, particularly on the portfolio management side. So, if there's a 3 or 4 person team running a portfolio and one leaves, hey, from what we've seen in our experience, the process remains in place. And I've used it a few times. The integrity of the process isn't jeopardized. So we like that team approach, knowing there is turnover, but at the same time, we don't like to rely, like the funds that we put on our menu, we don't like to have it rely on one specific person. Okay. In addition, we'll look at the resources dedicated to the strategy. Okay. I.e. the systems, how many people, because we really want to make sure the strategy itself is critical. It's important it's an important asset to their organization. Okay. And from an asset growth perspective, because that's another thing we look at, asset growth. As you might expect, we'd favor, moderate growth and controlled growth over rapid, because moderate growth is, unquestionably easier to handle. And that goes in particular for mid and small cap mandates, where if you have rapid growth, it can, capacity constrained strategies can, it's hard to put some of that money to work as quickly as you'd like. So there can be a cash buildup, which is really not what we're looking for. We'd like to have portfolios fully invested. Sorry. Just getting to the right page. Okay. So, as I mentioned a few minutes ago, invariably at some point, a fund isn't meeting expectations. So, in this case, in a case like that, we maintain a watch list and the fund would end up on the watch list. And this page provides transparency into our process, sort of goes inside the screens. And, you'll notice there's 8 screens on the page, 4 quantitative, 4 qualitative. It just, quite honestly, it just ended up that way. That's what's output from our process. When we went to put it on paper, the process wasn't designed to say, okay, we have to balance it. But after we sat down and looked at it, we said, wow, it really is a balanced approach. So now there's also sub-screens below these. But, just so everybody knows, these are the screens. And for a fund to be placed on watch, and I'm going to say typically, it has to fail 2 screens. Okay, there's exceptions with every rule. Like, for example, if a whole team left on a strategy, that automatically would put something on watch and probably would get it, replaced. But generally speaking, it has to, there have to be 2 alerts, okay, or 2 fails. And, from a fund can be on the watch list, we'd say a maximum of 6 quarters. Okay? That doesn't mean we can't make a change or pull it from the watch list because it corrected itself before 6 quarters, but that's the maximum time. And then I don't want to say we're forced, but we will make a decision whether the fund we can pull it off the watch because it's corrected itself or it's time to replace. So those are rules of thumb for the watch list. And we go to the next page. Okay, and on the next page, this is really the fund status, this is our report card page. Okay, this is a live report card that's included, in every quarterly report we send out to clients and advisors. Okay, so everyone gets a report card. This is the live one for a plan that we're already working with. It's simply and easily, just so you can see it on the page, but it shows the funds on the menu. Listed down the first column, and then if a fund is on the watch list, okay, you would see that in the watch list column, which is the second one in from the left. Okay, what it would show is not a yes, but it would show the quarter during which we placed it on watch. So if it was placed on watch in the 4th quarter last year, it would say 4Q17. And so this would be its 2nd quarter on watch. Now again, this plan doesn't have any funds on the watch list, but what you can see is there is an alert for the American Beacon Fund. I'm not going to go into it too much in detail in this call, but suffice it to say, in the comprehensive quarterly investment report, if a fund is on watch or if there is an alert on this page, you will have the details on why that fund is on the watch list or why there is an alert. Okay, so that information, is written by us here at Pentegra. It's provided to you as the advisor and the sponsor, so you're aware of what's going on with the funds. Okay, and I think everybody agrees, we tend to spend most of our time with client meetings or with advisor discussions talking about the problem funds, right? It's rare we'll talk about the fund that doesn't have the alerts, that's passing every screen. So the focus tends to be, and I think rightfully so, on those funds that might need a little extra work, a little extra, focus. This really is the one page. If you're preparing for a meeting and do not have do not have time to get through the entire report before a meeting, this is the one page I always encourage clients and advisors to look at because it gives you the status, right? This provides you with the status of all of the funds in the menu. Okay, and the next part of the process, because this is all part of the process, is the fund review process. Okay, in the end, there's a comprehensive quarterly report that you receive. Okay, and I'm not going to go through all these, but the report includes the report card, as I've said a few times, commentary and recommendations for funds, returns for various periods with comparisons to peers and market benchmarks, risk measures, and expense ratio rankings, as I mentioned earlier. But from our perspective and your Pentegra reps perspective, it's not nearly enough to receive the report from us or from the rep. It's just important for at least once a year to walk through the report. All right. so you can, remain, comfortable with our process, so you understand and know the status really firsthand from us on each of the funds in the report, and also to make sure the funds are adhering to the parameters prescribed in the IPS, or investment policy statement. Very important. Okay, so it really completes my prepared remarks. We have, I'll summarize by just saying that, I hope this, the discussion provided you with a better understanding of our process, not only our process, but the type of analysis that goes into it. And at the same time, with this, and again, I know it's a high level view, we didn't drill into all of the details, but hopefully it gives you comfort that, your plan, or your client's plan is in good hands with PENTegra. So, I'll close by just saying, before we go to questions, I'll just say, we really do appreciate your support and interest in our services here at PENTegra. And, quite frankly, if I hope to meet all of you, if I haven't already, at some point in the future. So, I will, I can open that up to questions if there are some. I do notice one that came in, and, the question that has come in is, can we get a copy of the slides? Yeah, absolutely. That's part of the process with the PENTalks, is to make sure that the information gets out to the clients and advisors, because we want you armed with as much information as you need to make informed decisions as well. So I don't know if there's any other questions, but please fire away if there are. Okay. Doesn't look like there's any. Oh, there's another question. Wait a second. One second. I'm trying to read this question here. Hold on a second. Oh, here we go. Another question is this? Yeah, it's recorded. So another question came in: is this being recorded? Yes, it's being recorded. So again, you'll have access to this, or others in your organization or your clients can have access to this. Following the conclusion of this, we'll get this out shortly thereafter. Okay, those were the only two questions. So again, we appreciate your time and everybody participating and joining in the PENTalk. And stay tuned, because there'll be a number of others in the future. So thank you, everybody.